Hello, everybody, and welcome. And here we go with accounting changes and error corrections. Okay, so here we go. My disclaimer and copyright notice. The information and opinions in this presentation are those of myself and not my employers or any other affiliated organizations, including but not limited to Irvine Valley College and the South Orange County Community College District. Presentation is for educational purposes only and does not constitute any legal or accounting advice whatsoever. This presentation is copyright 2008 to 2026 by Bennett Tchaikovsky. All rights are reserved. Any distribution is strictly prohibited. I will be referencing third parties. However, I do not claim any copyright into that information of those third parties. Okay. So when we're looking at accounting changes, and this can kind of happen because we don't have perfect information. And remember, a lot of times when we're going through and say, for example, if we're going through and, computing depreciation expense, the only thing that we really know is acquisition cost. Salvage value is an estimate. Estimated useful life is an estimate. When we're dealing with bad debt expense, that's also going to involve a lot of judgment. So when we look at this here, is we've got essentially three different topics. We've got changes in accounting principle, as changes in estimate, and then we've got a correction of errors. Now, when it comes to the changes in accounting principle, we generally, once we adopt something, we do not want to go through and change it. Now, how can we essentially make sure that that's going to happen? Again, we're not going to be perfect, but for example, if I was to open up a business similar to Home Depot or to Lowe's, I would go look at to see is like, well, what type of accounting system are they going through and using? Are they using FIFO? Are they using weighted average? Because if those in my industry are using one accounting principle, and I'm, say, an outlier of not using it, that's not going to be ultimately be good because then you lose that comparability between companies and it may raise some sort of a flag. But again, that's neither here nor there. And then lastly, how do we correct errors? And this is actually alluded to in an earlier chapter in intermediate accounting in the very first semester is when, well, if we have an error from a prior period, do we shove it into the current period? And the answer is going to that is to be absolutely not, because the current period that we're showing to our investors is in fact the current period. We don't want to go and put prior information. So what we're going to end up doing is adjusting beginning retained earnings. So why are there accounting changes? The FASB comes out with something new. There's a new tax code. There's a new big, beautiful bill. There's something that's happening there. A company basically voluntarily changes from one acceptable accounting method to another. For example, FIFO to average cost. A company revises an estimate based on new information. For example, the useful life of an asset, or the company discovers an error from a prior period. And when it comes to consistency, we got to make sure that we are using the same accounting methods from period to period. So if we do make a change, what we are more than likely going to need to also do is to show prior periods, like so that the financial statements basically remain comparable. So we're going to have to apply it retrospectively, which essentially is going to be an absolute nightmare. So this is something that we're going to talk about, but in practicality, you really want to try to avoid this. But it's tested on the CPA exam. Okay. So what is a change in accounting principle? Okay, a change in accounting principle occurs when a company switches from one GAAP principle to another. Common examples: FIFO to average cost, straight line to double declining balance, completed contract method to percentage of completion method. The general rule is when a company changes an accounting principle, it must go back and restate all prior period financial statements presented. Boy, that sounds like a great time, as though the new principle had been used. And again, when you show this on your financial statements, you're going to have to put on there as restated. And then you're going to have to show in the footnotes basically below that why are we restating it? So again, this creates Well, creates more work for us as CPAs, so we got to keep ourselves employed. So I guess this is one way to do it, although I can think of some other better ways to do it. Okay. CAP or change in accounting principle, not to be confused with another inverse. So it's PAC, Political Action Committee, or CPA, which is constant pain in the, oh no, it's certified public accountant, or cut, paste, and assemble. So steps for retroactive application, we're going to go ahead and calculate the cumulative effect of the change on all the prior periods. We're going to adjust the beginning balance of retained earnings for the earliest period presented. We're going to restate all prior period financial statements presented in the comparative statements. Again, sounds like fun. And then we're going to disclose the nature of the change and why we went through and did it. And remember, if you're going here and you say, well, why did we make the change? Because it's like, well, our net income went up because we chose average cost instead of FIFO and like, or X-Force. Right? That's not going to work, right? And you don't want to be doing this. You never, ever, ever want to be choosing an accounting method to mess around with it. The numbers are what they are. If you can't make the numbers, then talk about why, what happened business wise. Or you don't want to basically blame it on the accountants because believe me and trust me, everybody's going to try to blame everything on you. So not something what you want to do. But when we go through and do a journal entry, the way that we're going to be ending up doing this is we're going to essentially be debiting inventory or whatever that asset may be if inventory is in fact impacted. And then we'll be crediting the retained earnings for the cumulative effect of that change in principle. So again, when we have a change in accounting principle, remember we're really reflecting an adjustment on balance sheet accounts. We're not hitting income statement accounts except for the current period. Now, what if the retrospective application is impracticable? And I'm not sure if I said that right. Impractical. I don't know. Impracticable. I don't know. I'm not saying it correct, but there you go. Sometimes it is not possible to apply the change retrospectively because the data needed no longer exists. Assumptions about management intent of the prior periods cannot be verified. And so essentially the solution would be a prospective application. And you would have to, again, go through and disclose why you were only handling this prospectively. So again, it could be something where along the lines, if there is a change in the way like if there's a change in accounting principle. So again, you're going to handle it prospectively. What you will also oftentimes see companies do is you'll list out, let me go and show this to you. This will be the best way to go through and to look at this. Okay, so what you'll kind of go through here, and we're at Meta Platforms for their 10K for the year ended December 31st, 2025. So if I'm talking to Future Bennett, hello, Future Bennett, what's happening? In any event, you've got organization and description of business, and then summary of significant accounting policies, the use of estimates, basically revenue recognition, cost of revenue, contents cost. So the first thing we're doing in our financial statement footnotes after the financial statements is we're describing basically what are the significant accounting policies that we are going through basically, and in fact, using for our different basically areas. Like, so here, fair value measurements, in level 1, 2, and 3 inputs, variable interest entities, and the like, lease obligations, loss contingencies, goodwill. And again, you're seeing now, here we go. Accounting principle, accounting pronouncements not yet adopted. So in November 2024, the FASB issued ASU 2024-03 income statement reporting comprehensive income, expense disaggregation disclosures, disaggregation of income statement expenses. This guidance requires disaggregated information about certain income statement expense line items on an annual and interim basis. The guidance will be effective for annual periods beginning with the year ending December 31st, 2027, and for interim periods thereafter. The new standard permits early adoptions and can be applied prospectively or retrospectively. We are evaluating the effect that this guidance will have on our financial statements. So a lot of times it will kind of tell you how you can go through and adopt it. So what companies will do, such as Meta Platforms, is they may say, well, we're going to get ahead of this, and instead of having to go through and having to restate prior periods, we're going to take some time and basically go through and kind of figure out how this works. But again, you'll see this like in terms of this is where you'll actually see it in practice. Okay, so let's go ahead and take a look at this next one right here. So we've got changes in accounting principle, and then we've got changes in accounting estimate. And this is what I was alluding to a little bit earlier. So what exactly happens here? Like we are making estimates all the time, right? So common examples, useful life of a depreciable asset, residual salvage value of an asset, allowance for doubtful accounts, warranty liabilities. In accounting, we're making constant estimates. Now, the key is when we are doing as management, when we're making these estimates, we want to use the best information we have available. And that way we can show the auditors, well, this is the information that I use and it's best information that I had available to me. And then the auditors can basically look at that. They can do their own assessment and say, yeah, that's appears reasonable. So these are examples of change of estimate. And so when we have a change in accounting estimate, this is not a change in accounting principle, it's a change in estimate. We are going to handle it prospectively, meaning we're going to basically handling this going forward only. There is no restatement of prior periods. Because why are we not handling it retrospectively? Because estimates are by definition based on the best information we had available at the time. It would be misleading to restate prior periods for information that was not available then. So again, for a change in accounting estimate, we're going to handle these prospectively. So here's an example over here is that if you had a change in accounting estimate for depreciation expense, so say basically what you're going to go ahead and do is you're going to calculate, if I'm depreciating an asset, I calculate the book value up until the time of change. And then I'm going through and using the new information going forward. So that's what you do. You basically say, okay, if I'm changing the estimated useful life, that's fine. Usually it's going to go down or go, unless I have a fleet of forerunners, it's going to basically be going down, not up. But again, we're going ahead and essentially, changing. We're basically going to handle those changes prospectively. Okay, so again, what is the difference? The key difference is here between a change in accounting principle versus a change in estimate. Definition, we're switching methods for a change in principle. We're going to have to treat it retrospectively unless it is impractical to do so. And boy, oh boy, are you going to have to document that one. Prior periods are restated. And the answer is yes, because then you lose, remember, you lose that comparability factor. Now, for a change in estimate, we're going to only handle these prospectively, and then we're not going to go through and change prior periods. So sometimes it is impossible to separate a change in principle from a change in estimate. For example, a change in depreciation method. And then for that case, we'll just handle this as a change in estimate, meaning prospective treatment applies. So again, it's kind of like a little bit more of a gray area, but again, like when it comes to, you have to kind of look at what the material effect is going to be on that change in estimate. So I want to thank you for watching today. Please feel free to like and subscribe to the channel. I don't know if it helps me at all, but I guess it helps my numbers. I'm getting close to about 5,000 subscribers. Feel free to leave me a comment, or if you want to send me an email, please feel free to do so at ivc30cpa@gmail.com. And I will see you on the next video. Have a great day.